So let's begin walking through the budgeting process. We're going to start with the sales budget. And to do a sales budget, we need a sales forecast. So to get a sales forecast, you don't go to accounting or finance. You go to the marketing or sales area, because those are going to be the experts that are going to understand what is coming down the road as far as the sales that are expected. So sales forecasts come usually from the marketing department, and they'll have sales that they know that are already on their books, that they've already made, that are coming down the road. And then they'll take that information and they'll kind of tweak it. They'll kind of look at the economy. Is the economy strong? Is the economy weak? How is that going to affect their sales in the upcoming period? And then they'll maybe look at the industry that they're in. Are they in an industry that's on the upswing, or are they in an industry that's maybe a mature industry? Then what about the business? Like how is their specific business doing against the competitors? What kind of market share do they have, and are they gaining it or losing it? Historical trending information. Where are their sales typically at that point in the year? Take a retailer. A retailer usually gets a lot of sales in the fourth quarter. So that historical understanding of how the sales will change throughout the period is very useful. And then what about technology? New technology coming to the business could help them with efficiencies. It could mean new products. It could mean faster turnaround times. So understanding the technology that could be changing could be helpful in forecasting their sales. And then advertising, for example, do they have an advertising campaign? Are they going to advertise a product? And then finally, I just put etc. because every business is different. Every business has their own nuances that need to be understood, and marketing experts are the ones to go to when you want to know the sales forecast and all those extra elements that are involved. Once you have your sales forecast, you can move forward. We have one tab called our Given tab, and it provides us with all the information that we're going to need to do our budgets. Managers are going to have to gather this information and put it together. And we'll notice that we have a sales forecast here. So the sales forecast is from January all the way to May, but we're only going to do the first quarter. That extra information, however, might be helpful for budgets as we move along. But just grab from here what information you need for each of the budgets that you do. So we'll take our sales forecast and we'll bring it to our budgets area. Our company is Tasty Potato Chips. Of course, we make potato chips, and we'll start by just taking the information from the given sales information, and we'll put it in our sales budget. We're just going to do for the first quarter, January, February, March. We expect to sell 30,000, 20,000, and 25,000 cases of potato chips in each of those months. Then we look at the selling price per unit. So that's in the given information. We were given that the price was $20 per case, and we're not expecting that price to change anytime soon. So if we take our unit sales of 30,000 cases of potato chips times $20 per case, we get our total sales in dollars. We're going to use this information now to go down to our production budget. So the production budget is how many cases of potato chips we want to make in our factory. That's different from how many cases we expect to sell. Now, why would we have differences from what we want to sell and what we want to make? Well, a lot of times managers want to make a little bit of extra because these expected or estimated sales could be a little bit higher, so they might want to have extra left over. That's why the amount of production is not the exact same as the amount of sales. But we do want to start with the sales budget. So we'll take the information from the sales budget and move it to our production budget. So we just drop that in. Now notice also we have December and April. Even though we're doing the quarter, which is January, February, March, I'm adding a couple of extra columns. That's just for your benefit. You won't see this on the actual budget. I'm just adding those extra columns at the beginning and the end so you can see the flow of information. That's the only reason. It's just for the learning process. So the next thing we want to see is the desired ending inventory of potato chips. In other words, how many cases of potato chips do we expect to have left over at the end of each period? The reason we want to have some ending inventory is because, first of all, what if we sell more than we expected? Then we need to have some extra ending inventory. And also, we want to have some left over for February. We don't want to start February having sold everything in January. So that's the reason we want to have a little bit extra. And how much we have extra is up to you, the manager. If you want to have a lot of extra inventory so you never run out, well, that's fine. You can have a lot of extra inventory. That's why it's called desired. In that case, you run a low risk of running out, but you run a high risk because stuff can happen to that inventory. You have to store it in a warehouse. It could get damaged. It could go obsolete. Another problem is that it's costly to store extra inventory. If you go lean and only make just enough for you to cover your sales, well, that's great. You'll save money, but you run a risk. So how much do you want to have is up to you. In our case, we're going to go to the Given tab to see how much inventory they want to have. So when we look at the finished goods area, it says that we want to have 10% of next month's estimated unit sales. The 10% of next month's sales means that you take the next month and you drop 10% into the current month. So January, you want 10% of the next month, which is February. And February, you want 10% of the next month, which is March. And then you see we have April up there, and now you can see why, because we want to have 10% of April's in March, and we need to know what April is so we can figure that out. That's why I put that April column in there. Again, you wouldn't use that in your real budget because you wouldn't want to have that extra column there, but we're going to use it to learn with. And we'll see why we have December there for now. For now, just keep in mind that's going to be useful in a little while. So the total amount of finished goods we need would be for January 32,000 units of potato chips. However, we don't want to make 32,000 units of potato chips. What if we already have some cases left over from last month? If we have cases left over, then we want to use those up and not manufacture those. So let's use those up, and we'll get that from our ending inventory. So notice that the ending inventory from the previous month becomes the next month's beginning inventory. In other words, if you ended with 3,000 units of potato chips in December, that means you started January with 3,000 cases of potato chips. So January's ending inventory becomes February's beginning inventory. Now we're going to subtract that because we don't want to make it. So the amount of units to produce is going to be the total finished goods needed minus the beginning inventory. So for January, we needed 32 cases of potato chips, but we already had 3,000 left over from December, and so that means we need to produce 29,000 cases of potato chips. So what we need is not the same as what we produce because we have beginning inventory left over. Now notice for the quarter, if you notice the quarter, our ending inventory comes from March, and our beginning inventory for the quarter comes from January. If you want the unit sales, you add those up, but the beginning inventory comes from the beginning of the period and the ending inventory comes from the end of the quarter. Next, we're going to do direct materials budget. So the main material that we need for making the cases of potato chips would be potatoes. So how many cases of potatoes do we need? Well, we're going to start with how many cases of potato chips we're going to manufacture, so that the amount from the production budget gets moved down into the direct materials budget. That's how you begin your direct materials budget. So if each case of potato chips needs 5 pounds of potatoes, then the direct material for production would be 145,000 pounds in January. So that's all we're doing really is taking the cases of potato chips and turning them into how many pounds of potatoes. Now, we're not going to end here because we might want some extra potatoes. We don't want to buy just enough because we could have a situation where some of the potatoes are damaged or some of the potatoes get messed up in the process of making them, and a batch gets thrown out, and then all of a sudden they have to make some more potato chips and they need extra potatoes. So how many potatoes should they have extra? That will be their desired ending inventory. So to get that information, we go to the Given tab. It shows us that each case of potato chips needs 5 pounds of potatoes, which we saw. And it also shows us that the managers desire 10% of next month's direct materials as their ending inventory. It also shows us the cost per pound as $1.50 per pound. The ending inventory, as it's stated in the given area, is desired to be 10% of the next month's production needs, of the number of pounds they need for production. So 10% of February's direct material needs would be 102,500 times 10% gives you 10,250 pounds of potatoes. That means that for January we need 155,250 pounds of potatoes. February we need 10% of March's, and then we're going to use April to determine how much to have as an ending inventory for March. We did December, so we would have the beginning inventory for January, which we'll see in a second. So as you can see, the ending inventory from December becomes the beginning inventory for January. The reason we want to know what the beginning inventory is so that we don't buy potatoes that we already have. If we're expecting to have 14,500 pounds of potatoes at the beginning of January, we don't want to buy those. We want to take those out of our number of pounds of potatoes to purchase. Instead of buying 155,250 pounds, we already have 14,500. We only need to buy 140,750 pounds. We also want to make sure we have enough money to purchase that material. As we saw earlier in the given information, each pound of potatoes cost us $1.50. So that means the total cost that we need for direct material would be $211,125. This allows the financing and accounting department to make sure that they have the cash or the credit in place to get the materials. So purchasing wants to know how much to buy, and then our finance and accounting area wants to make sure we have the cash to cover those costs. Next, we're going to look at the direct labor budget. Now, this budget is very important for the HR people. They want to make sure they have enough people in place at the time they need them. If you don't have enough people to make the potato chips, it doesn't matter if everything else is right, you're not going to make any potato chips. You need to have the labor in place. So we'll start by taking the production budget and moving that information into the direct labor budget. We want to know, in other words, how much we're going to need to produce in each period so that we know how many people to have to produce that. When we go into the Given tab, it tells us that it takes us 0.05 hours, which is for our laborers to make a batch of potato chips. And our wages are $22 per hour. Now, that's not necessarily how much we pay the workers. That's the total cost of the workers, including benefits, payroll, tax, all of those things. So in January, we need to make 29,000 cases of potato chips. Each case takes us 0.05 hours. That means we need 1,450 hours of labor. February, 1,025 hours. In March, 1,285 hours of labor. This is very useful for the human resources area. Again, this is what they need to know so that they can have the right people in place. If there's going to be a spike in labor, for example, we all know that retail needs a lot more people in November and December than they need in other times of the year. So we need to have estimates for our labor needs in order for the human resources to have the time to get the right people in place, to get people trained and get people hired and go through and make sure they've had security checks and all that. Now, knowing how many hours of labor is very useful for them, but they also want to make sure in the accounting and finance area that we have enough money to pay the payroll. We saw from the giving area that it's $22 per hour, so that shows us how much we need in available funds to pay the labor in January, February, March. $31,900 in January, $22,550 in February, and $28,270 in March.